Siri, should Goldman Sachs go to jail?
I found 2 correctional institutions a little ways from you.
You know, if you just turn that dial on the TV set today, you're going to see a movie or something out there that's talking about our financial system. We've had a whole bunch of them, right? We've had Margin Call and Wall Street Conspiracy and Stock Shock and Radio Wars and Too Big to Fail. Love Too Big to Fail, right? Because let me tell you something. I think the media is too big to fail. That's what this is all about. See, we've been telling them about naked short selling now for many, many years. And they have done absolutely nothing to bring it to the limelight. As a matter of fact, let me show you how they report on naked short selling. All right, so let's go back. I've been chasing this for probably 10 years with a whole bunch of other people, and we've been talking about naked short selling now forever, and it's been real hard to get everybody to understand what it is, especially when you have everybody out there in the limelight saying it's nothing, right? Telling us that it doesn't exist, telling us it's a figment of our imagination. It's a way for a company to complain about its failing stock price. I mean, they just kept brushing it off like it was absolutely nothing. Here's an example. Listen to what Jim Chanos had to say about naked short selling.
Well, I think the phrase I would use would be red herring. It sounds ominous, it sounds nefarious, and by and large, it's a non-issue in the marketplace.
A non-issue, Jim? A non-issue? It's estimated that there's over $90 trillion in unsettled securities on the marketplace. And you consider that to be a non-issue? Wow.
Again, thanks to the SEC, short sellers, even naked short sellers, get to operate in utter secrecy, free from any of the disclosure requirements facing regular investors. That's not to say that the SEC couldn't find out who's responsible. That would be easy. But 1 year after Bear Stearns and 7 months after Lehman Brothers were put in their graves, nobody, not one person, has been held accountable. So, who are the most likely suspects? That's easy. Hedge funds. There's a small handful of huge multi-billion-dollar short-selling hedge funds with the resources and capacity to naked short on the level seen here. The people behind these hedge funds are among the richest in the world. They live in houses like this in Greenwich, Connecticut, this one in the Hamptons on Long Island, or this one right on Central Park in Manhattan. In fact, this guy, and this guy literally do live in these houses. In financial circles, they're treated like rock stars, and the New York financial press fawns over them in ways that would make a real journalist blush. Take, for example, the way CNBC gushes over short-selling hedge fund manager Jim Chanos, who is also head of the Coalition of Private Investment Companies, the U.S. hedge fund industry's primary Washington, D.C. lobby organ.
In a Squawk exclusive for 2 hours, our guest host today, legendary investor and founder of Kinnikos Associates, Jim Chanos. He's also chairman of the Coalition of Private Investment Companies, a large hedge fund body. Is Kinnikos an island? What's Kinnikos? Chanos is going to be an island. You could certainly buy one now.
Okay, so for those of you who don't know what naked short selling is, there's a simple explanation. Most people buy long. They buy it for $10, they hope it goes to $100, and they make the $90 worth of profit. Or you can sell short, okay, which means you borrow the stock and you sell it at today's prices. Let's say it's $50. And then you're banking on it going down in value, where you go out on the marketplace and you buy it back for, say, $30 and put it back in the account you borrowed it from. So you make that $20 difference. Well, what they have found is a loophole in the marketplace that allows them to not borrow the shares. So essentially, they are selling shares that do not exist in the marketplace. And they're creating counterfeit shares. The market doesn't know the difference. If you have $1 million company and you have 1 million shares of stock, the value should be $1. If you sell an additional 1 million shares of stock into the marketplace that really don't exist, the market doesn't know the difference. Now it has 2 million in float with $1 million company. So the value just went to 50 cents. Do that a couple, 3 more times, the company goes broke and they never have to deliver on the stock that they're supposed to borrow. So that's what naked short selling is. And not only did they attack the small companies, the penny stocks, and the smaller cap companies, but they attacked all of them. Even Lehman Brothers and Bear Stearns was attacked by them, as you're going to see in a couple of these examples.
These thieves, in my opinion, saw that they could steal money by counterfeiting shares of the small companies. They simply just went up the food chain into bigger companies.
Okay, so you just heard Mr. Christian explain how they just moved up the food chain, right? Not only did they move up the food chain, but they started eating their own, right? We had Dick Fold from Lehman said that naked short selling didn't even exist. And there's a clip right here on the website that'll show you him pleading in front of a congressional committee that he's being naked short sold at the end of the day, right? Look at Bear Stearns as an example. Look at this clip on Bear Stearns. If this doesn't tick you off, nothing will.
To understand what happened, first we need to go back to March 11th, 2008, when something very strange occurred on Wall Street. Somebody made what seemed like a ridiculous bet that, within the next few days, the share price of Bear Stearns would drop faster and harder than ever in that company's history, or the history of nearly any other company of its size. Was Bear Stearns in trouble? Well, like most every other American investment bank, during the housing boom that was ending in those days, Bear had made some bad investments in the subprime mortgage market, and, like most every other American investment bank, its balance sheet had suffered as a result. Yet on March 11th, Bear had several $1 billion in cash on hand, meaning there was certainly no risk that the company would be unable to make good on its near-term promises. However, somebody was betting otherwise. In a move many have compared to buying $1.7 million worth of lottery tickets, somebody bought $1.7 million in Bear Stearns put options, giving them the right to sell 5.7 million shares of Bear Stearns on a future date for $30 apiece. But here's the catch. At the time, Bear was trading at around $65 per share, and that future date was a mere 7 trading days away. Those were some unusually long odds, so long, in fact, that those options weren't even considered reasonable and thus not even offered for sale. Whoever bought them had to make a special request, which, at the time, seemed so outlandish, the trade itself sparked news coverage and one expert in the field to say of the trade, "It's not even on the page of rational behavior, unless you know something." Know something? Like what? Well, stick around for a few more minutes and I'll tell you what they knew. The day after those put options were sold, somebody sold some shares of Bear Stearns stock, but never delivered the shares to the buyers. Now that's not entirely unheard of. After all, accidents do happen, and so the system is set up to temporarily accommodate those so-called delivery failures by crediting the buyer's account with what essentially amount to IOUs, intended to take the place of the undelivered shares until the temporary impediment to their delivery can be resolved. The buyer never knows they've received IOUs in place of actual shares, and that's okay because in the meantime, until they can be replaced, those IOUs are treated like the real thing in that they can be bought and sold. In other words, the occasional stock delivery failure is a normal part of the marketplace. However, what was happening to Bear Stearns on that day was not at all normal. That's because on that day, over 1 million shares went undelivered, an unusually high percent of all shares trading. The next day, the number was still up to 750,000 shares of Bear Stearns that people bought but never received. The day after that, the number of undelivered shares rose to 2 million. The next day, nearly 14 million. By the next day, there remained 13 million of these phantom shares coursing through the system. Then 12 million, then 8 million. All told, between the day those options were purchased and the day they came due, somebody caused the supply of Bear Stearns stock to artificially swell by many millions of shares. To understand why this is a problem, we need only refer back to the most basic principle of economics, that is supply and demand, and the fact that when supply goes up and demand remains unchanged, price will always go down. One look at the chart comparing each day's delivery failures with the same day's closing stock price, and we see that, as expected, the principle of supply and demand held true in the case of Bear Stearns as well. What made all this possible is a small but lethal loophole in the United States stock settlement system, which, until recently, permitted a manipulative form of stock trading commonly known as naked short selling.
There's nothing that's done in the underworld that's not done in the upper world.